When was the first time that you were introduced to the concept of passive investing? Perhaps more importantly, when was the first time that you tried to explain the concept to someone else that wasn't already familiar with it? If you're like most people, when you find out about the world of syndications, you get super excited, you want to share it with your friends and family, you go to explain what passive investing is, how you can grow and protect wealth, and most people that you share this with are going to believe that it's too good to be true. Sure, we would all like to be able to go to Mexico, sit on the beach, drinking Mai Tais while we get electronic deposits directly to our bank accounts, but surely there's no way that this can be lucrative enough to actually be economically viable, right? Well, I happen to know a lot of people that have built up an extremely lucrative investment portfolio by doing that exact thing. In fact, we have one as our guest for today. So in this interview today, we're going to talk about the world of passive investing and hear our guest's answers to a lot of the most common questions in the passive investment space. So in this discussion, we're going to talk about what asset classes our guest is most bullish on right now. We're going to discuss if there's any markets that our guest simply says no to, regardless of the price point, regardless of the asset class, regardless of the size of the deal or the value add potential. Are there any markets that our guest is just simply not interested in? And also, should you be willing to invest in firms that aren't as well established, but can probably provide more flexibility? Maybe the terms are slightly more favorable, for example. It is the case that you do reduce risk when you're investing in larger firms that have more systems and processes and relationships, etc. But perhaps there are other firms that are relatively new that still have a really good investment thesis, and maybe the returns could even be higher. So let's have that discussion and see where our guest falls in that spectrum. So for those of you that don't know, our annual conference is coming up. It's the Intelligent Investors Real Estate Conference, and that's taking place in January 25th through 26th in downtown Los Angeles. And our guest for today, Travis Watts, is actually going to be there representing Ashcroft Capital. Yes, that's correct, Joe Fairless's firm. So if you haven't already gotten your tickets, you can do so at intelligentinvestors2020.com. However, you should know this, and if you already don't know this, I don't really typically go to a lot of real estate conferences. And the reason for this is that once you get to a certain level of knowledge, there are usually better ways to spend your time, unless you have a very specific networking goal. However, and this is a big however, when it comes to the content at IREC, even the most sophisticated investors are constantly at the actual educational sessions because the quality and the caliber of the other panelists and speakers is just extremely high. I cannot stress this enough. Yes, there is amazing content available on the internet, but when you put a lot of these ultra high caliber real estate investors and operators and managers and real estate professionals and self-directed IRA custodians, all these people that participate in the business differently, the relationships start to be developed, but also people are just willing to share secrets because they're amongst people that are of that caliber. And it creates a very interesting dynamic, the likes of which I have truly not seen. So if you're interested in that kind of thing, which I know you are because you're listening to this show, which kind of prides itself on the caliber of the guests, make sure to go to intelligentinvestors2020.com and use the discount code ASYM for $100 off. And I will see you in downtown LA, January 25th through 26th. How's it going, everyone? Our guest for today is Travis Watts, who is a full-time passive apartment investor and is now the Director of Investor Relations at Ashcroft Capital. Travis enjoys speaking on topics including creating more time for your life and financial freedom, becoming 100% passive in real estate, which is a topic that I'm obviously very passionate about, retiring early, using an IRA to invest in real estate, reducing taxes, and vetting syndication teams. Travis, thanks so much for joining us.
Hey, thanks so much for having me, Hunter.
So obviously, the passive approach to investing is something I'm super passionate about. I think that we're in front of a massive tsunami of interest in this space. It's something that as soon as I found out about it, I was like, why is everyone not focusing on this? This seems so favorable in terms of like the risk-adjusted returns. But that's not what we're taught in school. That's not what we're taught in academia. You have to go well outside of those means to learn anything about this. So how did you go about that route? What was your route towards uncovering the passive approach to investing?
Absolutely. So I had kind of a weird upbringing in that my dad got into real estate when he was 50 years old. So kind of later in life. And to that point, my parents had split when I was 5. And to that point, my parents were pretty much equal in terms of income and what they had and net worth and whatnot. And I just kind of got to see firsthand that acceleration that passive real estate could bring to the table as he was acquiring more and more properties. I really didn't know anything about real estate other than that. I had read a couple books during that process, which kind of piqued my interest, but I wasn't ready yet myself to jump in. So when that opportunity finally came, that was first and foremost on my mind.
Okay, cool. So talk us through that transition. Like, what was the first deal you started reviewing, and how'd you get involved in it?
Yeah, that's a good question. So I actually had a pocket of money saved up for college, and I ended up getting a full ride scholarship. And instead of blowing that money on like a car or something like that, I knew I wanted to put it into real estate in some way. So this was, I was going through college during the recession, which was really interesting. So on the outside of that, there weren't too many opportunities out there in the job world. I moved back to Colorado, and the first deal that I was able to find was in 2009. This was when the government had a program where they were giving first-time home buyers a $8,000 credit if it was your first home purchase. So I found a very distressed property. It was next to a college, and I moved in first as an owner-occupant to take advantage of that program. And then I ended up house hacking that and renting out some bedrooms, and eventually turned that into a full-time rental a couple years later.
Okay, interesting. So how did you find that deal? Like, what were the metrics that you were looking at that led you to believe, okay, this is a great opportunity? And by the way, for people listening, it's like, I think that people can be inclined to think, oh, wow, you bought a house in 2009 and it was relative success. Well, the market conditions were really favorable. If you were not investing in 2009, let me tell you, it wasn't just luck that you could find a good deal. It was like the sky was falling and no one knew where the bottom was. So to be able to, I didn't start buying properties until 2010 or 2011. 2009 was like the heart of the total nightmare, especially when it comes to real estate. Like, you may look at the graph and say, oh, wow, well, clearly we bottomed. Well, you can only see that now, right? At the time, we had claimed that we were hitting a bottom over and over again. And what really happened, it seemed like the bottom had been completely removed from the equation. So turn it back over to you. How did you identify this particular opportunity? And that timing must have been really interesting. Like, were your friends and family thinking you were completely insane?
That's a great point. And thanks for pointing that out, because we absolutely didn't know that was the bottom, right? That's all in hindsight looking back. And in fact, the market where I was investing actually didn't really budge until probably 2011 before it started really upticking. So,
right.
It was just a flatline deal. I probably could have got a similar deal in 2010 or 2011. So, yeah, I think that a lot of my friends and family did think I was a bit of a risk taker at that point. And in fact, my own family was saying, you ought to rent. Why are you buying right now? Just in their experience being homeowners, they had just lost a lot of equity and didn't feel like they wanted to tell me to do the same thing. So it was a risk to do that. Basically, you don't know what you don't know. And back then I was pretty naive. I was pretty new. Like I said, I'd read a couple books. I knew I wanted to be a passive investor. I didn't exactly know how. I felt like this was a good place to start, at least, getting into real estate somehow. It was going to be a place, I was going to have to live somewhere. And, I just kind of started experimenting with that property, with the house hacking and whatnot. But all I was really doing, to be honest with you, as far as metrics, I knew that market because I had grown up. It's in Fort Collins, Colorado. That's where I grew up. Mm-hmm. And so I knew the area. I knew it was next to a college. I knew there was a lot of renters there. I knew I could do something with that property eventually. And if nothing else, just live in it. All I was really looking at is what that house had sold for several years back and what I was picking it up for that day. And I just thought, I'm a big value add investor. I believe in just buying things, at a discount that needs some work and putting in that work to make it better and raising the rent.
Understood.
Yeah.
Totally. So it's actually, I went to CU my freshman year of college in Boulder and loved Colorado. It was absolutely beautiful, but way too cold. And so I actually moved very quickly, even though it's beautiful during the summer, which is when I visited. But quickly after that, I realized what I was really in store for and bounced after a year. But really liked Colorado as a whole. Just wanted to touch on something regarding the asset price decreases. I'm going to say something that I think some listeners might be surprised. I recently did a podcast about my portfolio and where I'm currently allocated. And so this may surprise you that I'm even saying this, but if you are interested in getting allocated in terms of outside of real estate, if there is ever something that you perceive to be of high value, like intrinsic value, and I don't really believe in that term. I'm an Austrian, everything's value is subjective, et cetera, but like something that you believe always will have some value, if it loses 30% of its price, it's worth looking at if you believe that thing is valuable. So if you have a 30% collapse in real estate, if you have a 30% collapse in oil or gold or silver or stocks, especially if it's a broad index, it's worth looking into just because you're at such an advantage. Or I should say, the likelihood that you are in such an advantage is very significant. So that's one of the things that I did when oil crashed like that. I did 2 investments in oil, 2 were in performing wells, and then 1 was in real estate that was in a city where the driving economy is based on oil. And especially the apartments that were in that city did exceptionally well on a risk-adjusted basis. So just wanted to mention that really quickly. Okay, so you've done the house hacking thing. You've taken advantage of the favorable government loans, et cetera. When did you start to be interested in what you and I typically consider the real passive approach to investing, where you're relying on an operator?
Yeah, great question. So again, back to how that all started, watching my dad, he was doing single family investing and calling it passive. And, he's, scaling up, 5, 6, 7 properties. And so I kind of set my target on the same goal at first, which was completely the wrong approach to be 100% passive. But, again, I didn't know what I didn't know. And I'd only read a little bit, gone to a couple little meetups and whatnot, and pretty naive. So I took the same approach as him with a couple exceptions. I did a couple fix and flips, and I had some buy and holds. I got into a little bit of the vacation rental aspect of single family. And simultaneously in this period, I was working a W-2 job in the oil industry. And I was working 98-hour work weeks. And this portfolio was quickly becoming a part-time job into more or less a full-time job as I kept acquiring properties. And I tried putting some property managers on site and doing various methods to try to be a little more passive. But ultimately, I wasn't seeing how I was going to scale that portfolio to 50 or 100 properties over time. So that's when I learned about syndications. It was through a real estate meetup, and just got a lot more knowledge, started listening to podcasts, started reading a lot more, did a lot of conferences, and just heard that term more and more and more, syndication, because I kept telling people I wanted to be passive, and I kept hearing them, give me that type of feedback. So it took me all the way until about 2015 to finally take the plunge and do my first real estate syndication. I was pretty skeptical myself. So I sat back about 6 months after I did that, and I just watched, the distributions come in. I watched the reporting, and I just kind of fell in love with that concept. And over the next couple of years, I completely transitioned my portfolio 100% into real estate syndications. So now my wife and I are just 100% passive in 14 to 20 different deals that we've done so far in the space, and that's all we do now.
How did you find that first deal back in 2015?
I started locally. That's a good question. There was a group here based out of Denver, and I just thought that was nice. I could go meet with them face to face and whatnot. They were kind of a newer group. And so I just took the plunge with them. I ended up doing 2 or 3 deals with that group. And then I kind of moved on to some out-of-state groups. I was hesitant to get out of Colorado at first. And then I quickly realized, there's some great markets out there and some great opportunities, especially like now in the cycle where I don't see that so much here in Colorado.
When you invested for the first time, were you, and I know every single year we all try to be better and better investors. But at the time that you made that first investment, did you consider yourself to be a savvy investor? Like, did you have a due diligence process in place for that particular sponsor, or was it more of a relationship-based investment? I mean, either are fine. Obviously, we've all been there. I just want to kind of understand, when the learning curve really started to change for you.
Yeah, I think that you learn the most from your mistakes. And so again, didn't know what I didn't know. I had done a fair bit of what I thought I had done a fair bit of due diligence and homework before I got started into the syndications. And in hindsight, I guess I did. But I was basing the main problem that I had, or the biggest mistake, was I was vetting out the pro forma way too heavily comparative to the team that was actually going to run the deal. And so it was one of those, hey, this group says, 8%, this group says 10, I'm going to go with 10, right? Why not? It's a higher return without considering that group really doesn't have that great of a track record or any, and that kind of thing. So I do far more due diligence now than I did in 2015, for sure.
Well, let's talk about that. So what are some of the steps or stages that you go through as due diligence, or what are some of the questions you ask, things you want to uncover? Where does your focus lie when it comes to due diligence?
Yeah, that's a great question. So I do get out there and network quite a bit. So I'm in a whole bunch of Colorado meetups, and also out in Florida as well. We have a place there, and I've got some family out there as well. And then I'm always traveling to do these events. So it usually nowadays, it starts with like a word of mouth referral, somebody who's invested with a group that I haven't. I'll kind of listen to their feedback, put that, into consideration, and then I'll kind of start the due diligence process. I'll go check out that group. I'll see if they align with my core investing philosophy, if they're doing the types of deals I like, if they're in the markets that, I think are good markets based on the research I've done. I just keep taking it a step further. I'll connect with them, jump on the phone. If I can, I'll meet up in person. I still love doing that. I think that's a great thing to do, to have a gut check face-to-face if possible. If not, maybe a Zoom call or Skype call or something like that. Yeah, and then I've got some people in my network that are ferocious due diligence seekers, and they ran background checks on probably most of the groups you've heard of out there. So I'll usually network with them a bit, get any feedback they have to share, and just do everything that I can, right? I mean, you're saving up your money, your 50K, your 100K, and you're putting that in the hands of someone else and hoping they're going to take care of you and make the right decision. So that's a big deal. I don't take it lightly at all, and I don't think anybody should. So far more focused now on vetting the syndicate groups themselves, their track record, who's on the team, what experience they have, their personal backgrounds, than I am concerned with the deal itself for the most part.
Yeah, for sure. And that's something that I think a lot of people make that mistake earlier in their career. Just to kind of add to what you're mentioning, one thing that I really like to understand, first of all, is if your background is pretty significant, is the team that you currently have in place and the software and the infrastructure that you currently have in place aligned with your background? Like, for example, if you claim to have $500 million of acquired value, but that was done at a different firm, which has 100 employees, and now you're at a firm with 15 employees, that's a huge difference to me, because especially late in the cycle, my main goal is to reduce the amount of unknowns associated with the investment. So a lot of questions that I'm asking sponsors now are, number one, what are your goals over the next 5 years? Not related to this particular property, but what does the scalability of your business look like? If you are able to accomplish that goal, how many additional team members will you need to bring on? If you are able to accomplish that goal, what kind of software will you need to integrate with? Because that's when the unknowns start to come. Is this person going to hire someone that's not a good fit and they have to rehire and stuff like that? So just for the listeners out there, I really like asking questions about, the general outlook of the business and how many unknowns are associated with accomplishing that general outlook. Let's talk about kind of the economic climate. So things have changed a lot. Obviously, one of the amazing benefits of these changes is that there's a lot more people talking about passive investments now, rightfully so. There's a lot more access to these types of deals. Unfortunately, this means there's a lot of new people entering the space, some of which are likely going to lose money when we have some kind of economic turnaround. What are some of the things that you're seeing in the marketplace that concern you? What are some of the things that you're saying, okay, this is kind of a red flag. I'm staying away from this strategy of investment, whether it be a geographic location or an asset class or a specific deal profile?
Yeah, that's a great question. There's several things. I've never been a new development investor. I've never been an A-class investor. Everybody has a different philosophy, a different take, a different risk tolerance, but I believe in buying something with current cash flow that I'm able to fix up, or the team's able to fix up, and we've got some margin in there, like you spoke to earlier. When you're buying with 20 or 30% buffer, that's a nice little cushion for the what if scenarios and the recessions and the unknowns that you alluded to. I don't like the idea of having something that's halfway completed as we go into recession and we don't have any cash flow or anything to back it up. And now all of a sudden our projected rents are just simply not going to happen. The other thing is, you talk about, the political scene and stuff, rent control coming out. That concerns me. It's really not putting enough initiative into those holding the value add investments to do anything about them, right? If you can't increase your rents, a couple $100 a unit per month over time, because you've got a cap on it, then you're more inclined just to kind of, let it sit as is and miss out on a lot of equity opportunity. So as of right now, I'm steering clear of a lot of markets, in states that are implementing stuff like that. And, there's a lot of controversy around the climate change, global warming, stuff like that, rising tide levels. So I'm staying away from coastal stuff personally, whether we're talking San Francisco, Manhattan, Miami. It's, again, personal preference. But, I don't really want to hold something long-term in an area where maybe the sea levels are going to rise, a few feet, and we're going to run into some issues down the road.
Well, right. So it's not only is it that perhaps the sea levels will rise, it's also about the potential buyer pool.
Yep.
Right. Because it's not just you that's hearing that. Right. So it's like, it could be the case that you think that that's not even a reality, or has no bearing on reality. But the reality is that a lot of people do. So you don't want to limit your buyer pool, especially late in the cycle. So it's a reasonable thing to say, regardless of like your stance on the particular topic. What are some of the asset classes that you're super bullish on?
Yeah. Well, right now, like you, I'm very concerned of where we are in the market cycle. So I'm very focused on recession-resistant investing, right? I don't like to say recession-proof, but recession-resistant. So value add, anything that you're going to buy at a discount, fix up, specifically multifamily, some self-storage. If you can find some good operators in the mobile home park space. I've done some little offbeat investments of investing in ATM machines or, distressed debt funds and various things. So I'm just more looking for opportunities that are a bit either uncorrelated from the general market cycles, definitely aside from the stock market, and, things that are going to be performing regardless of the economy in general.
Do you find yourself more drawn to investing in larger firms, or firms that you either have a more close connection with the principals, or more willing to be flexible with you in terms of not only due diligence, potentially maybe more favorable terms? Where do you lie on that spectrum?
Yeah, the first few deals that I did were with groups that only had maybe a couple deals under their belt, 2 or 3. One of them had maybe 5 deals under their belt. So kind of the newer, smaller groups. I don't know if it's so much the size of the firm more than it is just the track record. So what I look for now, is that, several deals have gone full cycle all the way through. And we typically have been investing with those types of groups, especially right now where we are in the cycle.
Totally. And, half of the return or so is usually generated by the sale of the asset.
Yeah.
If you succeed. And so it's half of the job. And if you can't do that second half, then you've waited your 5 or 6 or 7 years. And yes, you've gotten that 5, 6, 7, 8% cash flow. But in order to really get the benefit of investing in real estate, you have to get an additional 5, 6, 7% annually. And that comes when you sell the property. So it's important to at least consider that you inspect the team's ability to sell properties as well as just operate them and buy them, by the way. It's a relationship game, right? So the buyers and the sellers all talk together, and the more relationships you have, the more access to deals, particularly off-market deals. But getting a discount because you have an off-market deal, it only comes into play when you sell the asset. right? It's in terms of downside protection, sure, but when you sell the asset, that's when you actually get the benefit of not only that discount, but also adding value to the NOI. So important to kind of consider whether properties have been taken full cycle by the same team. So you mentioned that you're 100% passive, and this is a claim that I myself have made many times, and that's like I've been working 80-hour weeks recently, kind of like back at your oil job. And so it's interesting because I think this passive approach, people have an interesting perspective on this. Like they may imagine that you spend a lot of your time in Mexico drinking pina coladas. What is your kind of distinction between your passive approach to investing as well as integrating that with a career, basically?
Yeah, absolutely. And when I first heard the term syndication, I'm envisioning that, oh, geez, if you're involved with multifamily, you must be like a real estate guru, right? You must have some 20-year track record and know everything there is to know to be in these big asset classes. But what I come to find over time is, I'm side by side investing with a bunch of doctors and dentists and, business owners and CEOs, vice presidents, things like that. So it's working professionals that, quite frankly, love what they do, unlike my story. And it's not that they want to quit being an engineer. It's not that they want to quit working full time, at least not right now in their younger years. And so they're kind of building up a passive side to this where one day you're kind of looking at your portfolio going, well, I'm making, 100,000 passively over here and 100,000 actively. I could just afford to, quit my job if I want or retire early or have what I call time freedom. And that's what I was really after. I deem time freedom to be the ability to do what you want, when you want, as much as you want with your time. So it just more or less gives you an option so that you're not trapped into doing one thing and you're stuck to it, until you're 65 or 70 years old. And I just wanted that freedom. That was something very important to me early on.
And then you obviously have a love for real estate because you recently joined up with Ashcroft. Tell us a little bit about that transition and why you decided to go with that team, and also, what role you really play there.
That's right. Yeah. So I'm young enough that I still want to be productive. I still want to be doing something. Like you said, I don't want to be just sitting on the couch or drinking pina coladas in Mexico or something. So I've been investing personally with Ashcroft Capital, which is Joe Fairless's firm, for, several years now. I'm in 9 of their deals currently. And, just in my own network of family, friends, and, just some buddies of mine, I was kind of sending them, referrals and whatnot as I speak about what I do. They're one of the best groups that I've invested with so far. And so Joe Fairless asked me to come on board as part of their investor relations team because what I was doing anyway in my personal life was going to a lot of conferences and networking events and meetups. And so the only difference is now on occasion, I'll be there at an Ashcroft Capital booth compared to just being there solo on my own. So that's kind of what I'm doing with them in affiliation. But, their investing philosophy, their deals, the markets they're in, just everything that group has done and does currently just aligns very well with my wife and I. And that's why we continue to invest with them.
Certainly. And Joe's been a guest on this show a few times, and a lot of respect for him. He's also been kind enough to allow me to come on his show several times to talk about different various topics. And so big fan of Joe and all the brand over there at Best Ever and everything. There's been an incredible change in the way that financial education is shared. At the beginning of this podcast, I mentioned that pretty much no one went to high school and college learning about passive investments. Now that information is readily available. And I think an industry that's going to be revolutionized the most because of this change in financial education is the financial industry. The way that information is shared is not behind some massive paywall, but is readily accessible. You don't even have to download an app. It comes with your iPhone. You can listen to podcasts and get an MBA in real estate or finance. And I wanted to get some perspective from you on, number one, some of the resources that you get a lot of your information from. You mentioned that networking and in-person events are kind of your forte. What are some of the other ways that you get information and learn as much as possible given this change in the education space?
Yeah, we live in a vastly transparent world. I mean, between LinkedIn and Facebook and then online forums like Bigger Pockets, for example, there's so many places to go and just ask your questions, have a network of people doing exactly what you do, whether or not that's in person, like I like to do and I prefer to do, or whether that's just online where you can reach a much broader audience. And of course, podcasting. I mean, there's just so much, and YouTube. It's all over the place. Everywhere you look, there's information to be had, and sometimes that can actually be a bit of a downfall if you get caught up in analysis paralysis. Because there's 100 different sources telling you 100 things, and it's hard to read between the lines. So that's why I prefer talking to individuals one-on-one, just to hear their experience and which teams they prefer to invest with and why, versus just looking online and going to forums. But everybody's unique and individual, and if all you have time to do is jump on an online forum a couple times a week, and throw a question or two out there, I recommend doing that, because that's a tremendous opportunity that wasn't around 20, 30 years back. So
what is one resource that you either read or looked up or listened to that saved or made you money in the last 12 months?
Yeah, that's a good question. I do read quite a bit. So I'm going to name a book I read, not in the last 12 months. I don't know, it was several years back, but it was Tom Wheelwright's book, Tax-Free Wealth. And I never got into real estate necessarily for the tax benefits early on. But as I've continued to invest more and more, and I kind of see the impact now of how you can legally pay no tax if you're a real estate professional investing in things like real estate syndications, it's been a huge eye-opener for me, absolutely enormous. And that book broke down a lot of these key steps that I ended up taking as I transitioned out of being a W-2 employee. And it's just been tremendous. So that's a great book, Tax-Free Wealth.
I'm interested now. So first of all, I'm going to reach out to him because I think he'd make for a great guest. But tell me some of those steps, though, because obviously we all want to reduce our taxes, but especially since you actually implemented them, what are some of the things that listeners could learn?
Yeah. So with Tom Wheelwright, he founded a CPA firm. He is a professional real estate investor himself. And so what he's done is he's just enthusiastic about the tax code, whereas 99% of people just aren't that interested. It's just kind of tell me what to do. So the book is designed around, it's to fit you and your personal circumstance. So he talks to business owners, he talks to W-2 employees, and he'll talk to, real estate investors, oil and gas investors, and so he's taking the current tax code. He's got a new updated version of the book. It's generally the same, but with some new things since we had the tax reform in 2017. And yeah, I mean, everything from, vehicle depreciation to, your home office to, having your own LLC or having that maybe taxed as an S Corp. There's all these strategies and all these things you can implement. And then he breaks down the different types of investments, whether we're talking, self-storage, multifamily, real estate that you own and control, oil and gas, solar, and it's showing you what tax impact each of those can have, like in a proactive type of way, so that you can figure out for you which steps are going to be appropriate to implement, or that maybe you didn't know about, or maybe your CPA never told you about, because they're not necessarily in the business of being a proactive consultant for you to reduce taxes. They're more in give me all your paperwork and I'll file for you. So it's a whole different approach, but it's a great book, and yeah, he does programs and other things. You can pay thousands of dollars to do various stuff, but you could also pay $20 and buy the book and get a lot of value out of it if you're willing to read a book.
Yeah, right. And implement the strategies, right?
Yeah,
Reading is done for a lot of reasons. Some of the reasons are to have fun and to pass the time in traffic. But if you read a book by Tom Wheelwright, you're going to get some real impactful strategies that if you implement probably save you tens of thousands of dollars. So perfect. Travis, we've covered a lot of topics today, obviously focusing on the passive approach, and really glad to hear that you're integrating with Ashcroft over there, and really looking forward to IREC, which, by the way, we just confirmed Travis is actually going to be at IREC at the Ashcroft booth. So very much looking forward to that. Before we jump off, though, Travis, let the listeners know how they can learn more about you and Ashcroft and any resources that you wanted to share.
Yeah, absolutely. Best way to reach me is probably just by email. And my email is travis@ashcroftcapital.com. And additionally, if you want to learn more, we can definitely have a chat and a discussion, or you can visit ashcroftcapital.com/passive investor. And there's an amazing resource guide that's absolutely free. You can download. I think it's a 20-page guide. Goes into everything from vetting out sponsors to vetting out markets to, common terminology in the syndication world to, pretty much everything that we just talked about on this podcast. So that's a great resource to have. I wish I would have had that when I got started. That would have saved me from quite a few mistakes. So,
all right. Well, we'll be sure to link to that in the show notes page. Travis, thanks again.
All right. You got it. Thanks so much, Hunter.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.